Welcome back to Morning Markets on Thursday, the 23rd of March. In today's episode, we're going to focus on the US Central Bank and their decision to raise interest rates by another 0.25% to a level of 5%. Over the month of March, we've seen quite a material move in terms of interest rate expectations in the US. If we cast our mind back to the beginning of the month, markets were expecting interest rates to reach a peak level of 5.5% by the summer of this year, which meant a 0.5% increase in interest rates in March. Why was the market expecting interest rates to continue going up? Because of the inflation challenge which central banks have to contend with. They've got a target level of 2%. If we look at inflation at a headline level, inflation is coming down. It's moved from a headline level in the summer peaks of 9.1 to a level of 6% now, and on a core basis, 6.6 to 5.5%, but it's stickier than many market expectations were setting out. Why? Because the consumer is still spending. 40% of mortgage holders in the US refinanced in the last 2 years, which meant that higher interest rates is having very limited impact in terms of mortgage costs, and the employment market at this stage is very strong. And the Federal Reserve recognised this and therefore have revised up their expectations in terms of inflation numbers for 2023 and 2024 by about 0.1% from their December meeting. For context, in 2023, the Federal Reserve is expected inflation to sit around 3.6% on a core basis and 2.6% in 2024. Key aspect of both of those is they're both above that 2% target level. However, over the course of the month, we've seen a development in terms of some idiosyncratic members of the banking system in the US and the challenges which they've faced as a result of higher bond yields, an area which the US Federal Reserve did backstop to safeguard depositors. But in terms of what it's meant for expectations, then the market is currently viewing that potentially we are near the end of the interest rate hiking cycle in the US. There's potentially expectations for another 0.25% hike, but other market expectations are believing that that is the end. And then the central bank could start to cut through the end of this year, taking interest rates to a level of around 4%. And markets have responded to this. We've seen yields come in by around 17 basis points on a 10-year Treasury bond through the course of yesterday, which is a material move for one day. It's positive in terms of the return, but a material move nonetheless. And we may continue to see some of this volatility within the bond market as we see further news from the Federal Reserve and the realised inflation data. Federal Reserve are of a slightly different view. They believe that we get to a level of around 5% and just hold at that level. Powell did consider pausing at this meeting, but as I say, we've got an inflation challenge to address. Bank of England's expected to follow suit with a 0.25% interest rate hike in terms of their March meeting. All of these aspects we're going to dive into on a much deeper basis on our Do More With Your Money show, which will be released on Friday. So please do tune in, and thank you for watching.